You find a trading strategy on paper that looks entirely unstoppable. A highly profitable gold setup that promises heavy returns with a simple, repeatable pattern. The blueprint relies on 3 familiar components. First, a 9 and 20 exponential moving average cross to signal a shift in momentum. Second, a displacement candle, a massive, aggressive price movement in one direction. And third, a retracement into the lower half of that candle, giving you a discounted entry point. This visualization shows exactly why that combination is so incredibly easy to market. Across 123 qualifying events on gold, this setup hit a 1-to-1 reward ratio a massive 78% of the time, dwarfing the 22% loss rate. It gives traders a very convincing narrative. The moving average cross proves momentum is on your side. The large displacement candle proves institutional buyers are stepping in with conviction. And the pullback allows you to enter at a prime discount before the market resumes its path. It sounds perfectly logical, and it points to the exact spot where retail trading research goes entirely wrong. A 78% win rate compresses the chaotic reality of the market into a single binary outcome. It creates a dangerous illusion that actively hides the physical bar-by-bar mechanics that dictate whether your account actually survives a trade. To understand why, we have to isolate the variables. We need to ask if the 9 crossing the 20 moving average actually caused that 78% win rate, or if it was simply present when the move happened anyway. We ran a subtraction test. We took the exact same displacement and retest setup across 7 different markets, but we deleted the moving average cross requirement entirely. This chart displays the results of that isolation test across the broader sample. With the moving average cross included, the setup hit its target 55.1% of the time. Without the moving average cross, the result was 54.9%. It tells you absolutely nothing about the path it took to get there. Between your entry trigger and the final destination lies what we call the messy middle. This is the unpredictable bar-by-bar reality that a trader actually has to sit through. This graph plots a typical trade's path through that messy middle. Notice how the line dips deeply into a negative zone, plunging far below the initial entry point, sitting in sustained drawdown before sharply reversing upward to cross the target. Now we add a standard horizontal stop-loss line. The path physically intersects your risk limit, marking a failure point long before the target is achieved. Retail trading statistics contain an absurd contradiction. A backtest will stamp this trade with a giant green winner label simply because the target was eventually reached, completely ignoring the fact that a normal human trader would have been stopped out days ago. Being completely right about the market's ultimate destination is a useless metric. If the path the asset takes to get there violently violates your risk limits, your account is destroyed anyway. The solution is not to delete moving averages from your screen forever. The solution is to strictly downgrade their authority in your decision-making hierarchy. Indicators do not confirm a trend. They are simply alarm clocks. They exist to alert you that an area of interest might be forming and that you need to go look closer. Instead of asking if 2 lines crossed, you have to ask structural questions. Was a clear direction already established before the signal fired? Did the massive displacement candle actually break a meaningful structure? And was the retracement tightly controlled, or did price bleed deeply through the entire zone? Stacking multiple indicators on top of each other provides 0 extra security. A moving average cross, a fair value gap, and a market structure break occurring at the same time are often just different visual representations of the exact same event. You are not gathering independent evidence. You are counting the same price action 3 times. Predicting the direction of an asset is a tiny fraction of the battle. Mapping out the deep retracements, analyzing the adverse excursions, and surviving the physical path to your target is the only way an account stays alive. To see exactly how deep those pullbacks fell, look at this adverse excursion map inside the free Gold X-ray kit. It analyzes over 5,000 historical breakouts, so you can pressure test your setups and see if your account could actually survive the path. Click the link in the description to download the complete data.